If you or a loved one needs care and you've established that you will need to pay for some or all of the costs yourself, this makes you a self-funder. There are 9 main ways to pay for your care, which I summarise in my video, Paying for Care as a Self-Funder. In this video, I will explain the third of those 9 options, equity release, often referred to as a lifetime mortgage. When it comes to using equity release to pay for care, most schemes are designed for those who want to stay in their own home and receive domiciliary care, or where one spouse or partner needs residential care but the other continues to live at home. The money release can be used to pay directly for care fees or to create an investment plan to help cover care fees. Paying for care with equity release may be suitable where you need to fund long-term care and you've already paid off or nearly paid off your mortgage. A quick sale would make it difficult to realise the full value of the house, or when the property remains occupied because care is in the home or a spouse or partner remains in the property. Paying for care from equity release may not be suitable, however, where you currently live alone and may soon need to move into residential care. Equity release arrangements typically require repayment of the loan in full within a specified timescale if the owner moves permanently into a care home, although there are some alternative options available. You are unable to offer the lender suitable security. For example, a first charge is already placed on the property, or the property is technically owned by a third party such as a trust. Deciding to take out equity release is one of the most important and long-term decisions people make in later life. The consequences of your decision are likely to have significant impact on your financial well-being for the rest of your life. This makes it particularly important that you seek advice from a suitably qualified advisor. Ask your financial advisor whether they hold the Level 3 certificate in regulated equity release schemes. Also, make sure that all possible options of paying for care are considered, including making sure you're claiming all the benefits you're eligible for before going down the equity release route. The main advantages of an equity release scheme are: it can provide a guaranteed regular income or a large lump sum, and funds can usually be accessed more quickly than waiting for a property sale. You get to keep and stay in your own home, and some equity release schemes require no regular repayments of interest or capital, although some schemes allow for regular, sporadic payment of interest to reduce the amount of outstanding debt. The loan need only be repaid on death or on sale of the property. And of course, there's the potential to benefit from any future increases in the value of the property. Fixed rates prevent interest spiraling out of control, and many schemes guarantee that the total debt cannot exceed the value of the property. It's called a negative equity guarantee. What's more, when the house is eventually sold and the debt paid off, there may be some money left over to provide an inheritance. The equity released on the main residence is tax-free, and equity release schemes can help to reduce inheritance tax liabilities. It also keeps the property in your estate. So there's a lot of advantages, but there are also a large number of potential disadvantages that you should consider. You will not be able to release the full value of the property as compared to selling your property because the full value is never loaned. If using a home reversion plan where you sell all or part of your property at less than its market value in return for a tax-free lump sum or a regular income, or both, but you stay on in your home as a tenant paying no rent, you lose sole ownership of your home. Interest will be charged, which typically results in debt accrual, and it's usually higher than standard mortgage rates. Usually, the property must be sold when the debt needs to be repaid. Really importantly, an equity release plan might affect your entitlement to means-tested benefits, as any money raised through equity release is likely to affect the assessment of income and capital, and may have an impact on your tax status. An equity release plan can be inflexible if your circumstances change. They will usually need the provider's permission for someone else, such as a relative, carer, or new partner, to move into the property. There are costs involved, such as arrangement, valuation, legal and setup fees, and early redemption fees may apply. And if you sell up or die soon after taking out a plan, your estate could incur a loss. Lenders will expect you to keep the property in good condition, so you will need to set aside some money for ongoing repairs and maintenance. Critically, unless the money released is used to purchase a long-term care plan, the money could run out, meaning you will have to find alternative ways to continue paying for your care. And you may be wondering whether a standard mortgage is an alternative. It is worth noting that standard mortgages for those in later life are increasingly available for those who can demonstrate affordability. Interest rates are typically lower than equity release loans as regular repayments are required. Nationwide, for example, the UK's largest building society announced in May 2016 that it would now lend to qualifying borrowers up to the age of 85. If you do decide to pursue an equity release scheme, choose a provider that's a member of the Equity Release Council and will provide a no negative equity guarantee alongside a range of other standards. Taking out an equity release loan or standard mortgage may undermine the subsequent availability and access to a deferred payment scheme due to the fact that the local authority may not be able to secure the required first legal charge on your property. Equity release can feel like a minefield, but for some people it's worth considering as an option to pay for later life care. It is best to consult an independent financial advisor who's accredited by SOLA as a later life accredited advisor who can assess all possible ways for you to fund any care you may need in later life. They will build a lifetime cash flow that takes account of all your savings, investments and other assets and considers your income and expected expenditure for the rest of your life. They will help you evaluate each option. To find out about the other 8 main ways to pay for care, check out our show notes for links to other videos in this series. And thanks for checking out my YouTube channel. I'm Justin King, and my aim is to help people live successful lives. And that often involves understanding your money. I hope you've enjoyed this video. If you have, please press the like button to help more people like you find my channel. And check out the notes below for some useful links on things I've discussed in this video. For now, my name's Justin King, helping you live your best life.